Reviewing these adjusting journal entry questions can help you pass your next accounting test. I'm Scott Meister, and this is Test Prep Episode 6. In this video, we'll take a look at some financial accounting questions related to adjusting journal entries. Now, this video is meant for students in their first accounting class, and if you want to see more videos like this, make sure you subscribe to my channel and ring the bell to be notified when new videos come out. Also, if you know anyone that might benefit from this video, make sure you share it with them. The first question reads, during the first month of business, $4,500 of supplies were purchased. At month end, $250 in supplies were on hand. The month ending adjusting entry is debit to supplies expense $4,750 and a credit to supplies for $4,750. Debit to supplies $4,750 and a credit to supplies expense for $4,750. Debit to supplies expense $4,250 and a credit to supplies for $4,250, or a debit to supplies $4,250 and a credit to supplies expense $4,250. So a lot of times with a problem like this, I just like to do a T account so I can visually see what's going on. I've got a supplies T account here, and it should start with a balance of $4,500. And at the end of the month, I know that we've got a $250 balance. So I need to solve for a credit amount over here. And to do that, I'm just going to take the $4,500, reduce that by the $250, and that leaves me with $4,250. And so that number should be over here as a credit. So I know that I need to credit supplies for $4,250. It's an asset. We decrease the balance of an asset account by crediting it, so that makes sense. And then whenever we use up supplies, we're going to debit the supplies expense account. So the answer here then is going to be C. For question 2, it says the adjusting entry to record depreciation for equipment is debit equipment and credit depreciation expense, debit depreciation expense and credit equipment, debit accumulated depreciation and credit depreciation expense, or debit depreciation expense and credit accumulated depreciation. So whenever we record depreciation, we are going to debit depreciation expense. It's an expense account. We increase the balance of an expense account by debiting it. And then we are going to credit an account called accumulated depreciation. It's a contra asset, which means the normal balance is going to be a credit. So to increase the balance of accumulated depreciation, we're going to credit it. So the answer here is going to be D. For question 3, it says, if prepaid insurance isn't adjusted for the period, the expenses on the income statement will be understated, overstated, correctly stated, or not enough info given. So for problems like this, what I like to do is actually draw out the adjusting journal entry. So the adjusting journal entry would look something like this. We would debit our insurance expense, and then we would credit our prepaid insurance. And so now what they're saying is if this journal entry isn't recorded, what does that do to our expenses? Well, our expenses in this instance are going up because we debited expenses to increase the balance of an expense account. We debit it. But if we don't do the transaction, that means that our expenses are going to be understated. So the answer here is going to be A. For question 4, it says to accrue interest you owe, the adjusting entry would be a debit to interest payable and credit interest expense, debit interest payable and credit cash, debit interest expense and credit interest payable, debit interest expense and credit cash. So if we owe something, that means it's a liability. To increase the balance of a liability, we need to credit it. So we're looking for a liability account that we would credit, and we have one here in C. It's interest payable. And that makes sense. If we owe interest, that means we were going to pay it. So that's interest payable. And then we would debit interest expense. So the answer here is going to be C. It wouldn't be A because we wouldn't debit interest payable because that would reduce our balance. We're saying that we owe more, so that's not right. It wouldn't be B because interest payable, the same thing. We're not going to debit it. That would decrease the balance of what we owe. And here we're saying that we owe more, so that wouldn't be B either. And then it wouldn't be debit interest expense and credit cash because we haven't paid it yet. So it's not D because we haven't paid it yet. For question 5, it says, on October 12, 2019, Smithco paid $6,000 for the next 3 months of rent, November 2019 through January 2020. What is the adjusting entry on November 30th, 2019? Debit prepaid rent $2,000 and credit rent expense $2,000. Debit rent expense $2,000 and credit prepaid rent $2,000. debit rent expense $4,000 and credit prepaid rent $4,000, or debit prepaid rent $4,000 and credit rent expense $4,000. So a lot of times when I have a transaction like this, I like to record the very first transaction. So by that, what I mean is on October 12th, what would the journal entry look like? If we take a look at 10/12 and we paid cash, so that's a credit to cash, and that's $6,000. And we prepaid our rent, so that's debit prepaid rent, and that's $6,000. So prepaid rent is an asset. We increase the balance of an asset by debiting it, so that's why we debit prepaid rent. Cash also is an asset, but we have less of it now than we did before, and to decrease the balance of cash, we're going to credit it. So that's the very first transaction. So now what we're looking at is on November 30th, what does the entry look like? Well, we don't have as much in our prepaid rent account. How much did we use up in November? Well, if it's $6,000 for 3 months, that means that it's going to be $2,000 per month. So in November, we used up $2,000 of our prepaid rent. To decrease the balance of our prepaid rent account, which is an asset, we need to credit it. So we're going to credit prepaid rent, and that's $2,000. The account that we're going to debit then is going to be our rent expense account. It's an expense account. We increase the balance of an expense account by debiting it. So that's going to be rent expense, and that's $2,000. So the answer here is going to be B. Let me know in the comments if you have any questions about adjusting journal entries or these test prep questions, and let me know if this video is helpful for you. Question 6 says, prior to adjusting entries, unearned revenues represent overstated liabilities and overstated revenues, overstated liabilities and understated revenues, understated liabilities and overstated revenues, or understated liabilities and understated revenues. So I'm going to go ahead and just do a generic adjusting entry for unearned revenue. And unearned revenue is a liability. And whenever we're adjusting unearned revenue, we're going to debit it. So we're going to debit unearned revenue. And then we're going to credit a revenue account. If we don't do this, because it says prior to, so if we don't do this journal entry, what does that mean? Well, in this instance, our revenue goes up and our unearned revenue balance goes down. So prior to doing the journal entry, that means that our revenue would be down and our unearned revenue would be up. So our liabilities would be overstated and our revenues would be understated. So the answer here is going to be B. For question 7, it says, if an adjustment for owed wages isn't made for the period, the liabilities on the balance sheet will be understated, overstated, correctly stated, or not enough info given. So I'm going to go ahead and do the journal entry for the adjustment. And the adjustment would look something like this. It would be a debit to wages expense, and it would be a credit to wages payable. Wages payable is a liability account. We increase the balance of a liability account by crediting it. So if we don't do this journal entry, if we don't do this adjusting journal entry, that means that our wages payable is going to be understated, which means our liabilities will be understated. So the answer here is A. Question 8 says, using the straight line method, equipment costing $64,800 with an estimated useful life of 8 years and no salvage value would have a monthly depreciation of $525, $675, $7,425, or $8,100. So what we need to do here is just take $64,800. Normally with straight line, we would reduce it by our salvage value, but here they say we have none, so that's 0. And then we're going to divide that by 8 years. And that's going to give us $8,100, but that's for a year. So we need to make sure what we put per year. So then if we divide that by 12, that will give us our monthly amount. And when we do that, we end up with $675. So the answer here is going to be B. For question 9, it says, on December 1st, 2019, Craftco purchased equipment by issuing a 6-month 7% note for $120,000. Craftco's adjusting entry on December 31st, 2019 is debit to interest payable $700 and a credit to interest expense for $700, debit to interest payable $4,200 and a credit to interest expense for $4,200, debit to interest expense $700 and a credit to interest payable for $700, or debit to interest expense $4,200 and a credit to interest payable $4,200. So I'm going to take the note amount, that's the $120,000. I'm going to multiply that by the interest rate, which is 7%, and that leaves me with $8,400. And this represents the interest amount that would be paid for an entire year. But what we're after is just 1 month, December 1st to December 31st. So what I need to do then is I need to divide this amount by 12 months. And when I do that, I get $700, and that's going to be the monthly amount. So I know I can cross off B and I can cross off D because those are $4,200 and those aren't $700. So whenever we're going to accrue interest for an amount that we owe, we're going to have a payable on the books. The payable is a liability, and we increase a payable or a liability account by crediting it. So I'm looking for answer C here because it is a payable, which is a liability. That means we owe the money, and we're going to credit that. We're increasing the amount we owe. And then we also have to record an expense for the interest because that expense was incurred during the month of December. So that's why we're going to debit our expense here. For question 10, it says, if an adjustment for services performed isn't made for the period, the assets on the balance sheet will be understated, overstated, correctly stated, or not enough info given. So in a question like this, we're looking at services performed that we haven't recorded yet. And so a lot of times what we'll use is the account is going to be accounts receivable, and we would debit that, and then we're going to go ahead and credit our service revenue account. So I'll just put revenue there. And when we look at accounts receivable, that's an asset account. That represents money that customers owe us. And that's what we're talking about here. Services performed, but we haven't made that adjustment yet. So our asset balance would go up if we recorded this adjustment. But since we don't record it, that means that our assets are going to be understated. So the answer here is going to be A. For question 11, it says the adjusting entry to record the expiration of prepaid advertising is debit prepaid advertising and credit advertising expense, debit prepaid advertising and credit cash, debit advertising expense and credit prepaid advertising, or debit advertising expense and credit cash. So on a transaction like this, I typically like to write out the very first transaction that gave us a prepaid advertising balance. So that transaction would look something like this. We would debit prepaid advertising, and then we're going to credit our cash. And so now this problem is asking us to solve for the next step. How do we expire this prepaid advertising? Well, prepaid advertising, that is an asset account. We increase the balance of that asset account by debiting it, but here we need to reduce it. So we're going to credit prepaid advertising. And then we'll debit an account called advertising expense. Advertising expense is an expense account. We increase the balance of an expense account by debiting it. So the answer here is going to be C. The next question says, Angela Co. pays salaries to its employees of $14,000 every 2 weeks. The next pay date is October 11th for the 2-week work period of September 22nd to October 5th. Record the accrual of salaries and the journal entry on October 11th. So the first thing I like to do on problems like this is figure out a daily amount for the salaries. So I'm going to take the $14,000. I am going to divide that by 14 days. And I got 14 days because it's a 2-week pay period. When I do that, then I get $1,000 per day. Next, I'm going to go ahead and count from September 22nd to September 30th. So that's 9 days. I'll multiply the 9 by the $1,000 per day. That leaves me with $9,000. That $9,000 represents the amount we need to accrue for salaries for September. So I'm going to go ahead and do the journal entry here. I've got 9/30, that's September 30th. I'm going to debit salaries expense for that $9,000. So we recognize the expense at September. We're not going to pay it yet, so we're going to credit salaries payable. And that's for the $9,000. we're going to pay that $9,000 for salaries on October 11th. So on 10/11, we are going to debit our salaries payable. And that's $9,000. And by debiting salaries payable here, we are reducing our salary payable balance to 0 because on 9/30, we had a $9,000 credit. On 10/11, we've got a $9,000 debit, a $9,000 credit, and a $9,000 debit, net to 0. Then we're also going to debit our salaries expense. And this is going to be for the first 5 days in October because the pay period was from September 22nd to October 5th. And so we need to recognize the expense of 5 days, the first 5 days, that's October 1st to October 5th. And to do that, then we're going to take 5, because there's 5 days, times $1,000 per day, and that leaves us with $5,000. Then we're going to credit cash, because we paid cash, for the $9,000 plus the $5,000, and that gives us our $14,000. So in a problem like this, the first step, you can see I try to figure out a daily amount, and then I try to figure out the accrual amount based on the number of days in the first month. And then if I can solve for the first month, I can also solve for the second month as well. And that's going to help you do the first journal entry and the second journal entry as well. So the next question says, on March 1st, 2019, HeatCo issued a 6-month 6% note for $30,000 to ColdCo. HeatCo's adjusting entry on March 31st, 2019 is a debit to interest payable, $150, and a credit to interest expense, $150. A debit to interest expense, $150, and a credit to interest payable for $150. A debit to interest payable, $1,800, and a credit to interest expense for $1,800. Or a debit to interest expense, $1,800, and a credit to interest payable for $1,800. So I'm going to go ahead and do the math here. I'm going to take 30,000. I'm going to multiply that by the 6%, and that leaves me with 1,800. And this represents the amount of interest per year. But what I need to do is take a look at the interest for 1 month because it's March 1st to March 31st. So I'm going to divide that by 12 months. And then when I do that, I end up with $150 per month. So I know the answer isn't going to be D or C. And here, because we're talking about HeatCo, and HeatCo issued the note, so that means HeatCo owes the money. And when you owe the money, that's a payable or a liability. To increase the balance of a payable or a liability, we need to credit that account. So I'm looking at answer B here because interest payable is a liability and we increase that balance by crediting it. And then we also need to recognize the expense for that time period. And to increase the balance of an expense account, we need to debit it. So our answer here is B. So for the last question, it says, assume the same facts as in question 13. ColdCo's adjusting entry on March 31st, 2019 is a debit to interest income, $150, and a credit to interest receivable for $150, a debit to interest income, $1,800, and a credit to interest receivable for $1,800, a debit to interest receivable, $150, and a credit to interest income for $150, or a debit to interest receivable, $1,800, and a credit to interest income for $1,800. Well, since we already solved for the $150, we can mark off D and B. So I know that those are not the correct answer. The difference here is we're looking at ColdCo. So HeatCo owed the money and ColdCo is owed the money. So ColdCo should have a receivable on their books. The receivable is an asset account, and to increase a receivable balance, we need to debit it. And then they also should recognize some type of an income or revenue. And to increase the balance of a revenue account, we need to credit that. So we're looking for a receivable account that is debited and a revenue or income account that is credited. So our answer here is going to be C. I put these two questions in here because I wanted to show the relationship between the payable and receivable and an expense and a revenue account. So whenever you have a transaction like this, if one party has a payable and an expense, the other party is going to have a receivable and a revenue. So I just wanted to show the relationship here. That's it for this episode. Make sure you give this video a thumbs up if you liked it, ask questions or leave comments if you have them, subscribe to my channel for more financial accounting videos, and ring the bell to be notified when new videos come out. What questions do you have about adjusting journal entries? Let me know in the comments below and I'll get them answered. Additionally, check out the link in the description for my website, passaccountingclass.com. It's a great resource for accounting and non-accounting students that need to pass their accounting class. It has more videos on similar topics, a message board where you can ask me your questions, and discounted rates for one-on-one tutoring with me. I tutor students across the US via web conferencing tools and help my students succeed. I'm here to help, so feel free to reach out if you have any questions. Thanks for watching.